In today's video, we're going to discuss, should you lock in your mortgage rate? We're going to discuss inflation data, the Federal Reserve increasing their interest rates, and some of the penalties that come with a fixed mortgage versus a variable mortgage to help you make your decision if now is the right time to lock in your mortgage rate. So let's start with the August CPI data here in Canada. So as of August, we had a 7% year-over-year increase. That's since the prior August. It was under the estimate of what economists predicted of 7.3%. And it's been going down since June, 8.1% in June, 7.6% in July, and now 7% in August. That is primarily due to energy prices decreasing. Core inflation, which is a metric the Bank of Canada looks more closely at, which excludes energy and it excludes food. Now, the interesting thing is food is at an all-time high. It is one of the categories that hit its all-time high in August. Excluding those two items, core inflation is currently at 5.2% and it's down from July of 5.4%, which is a very good sign. We want to see that core inflation go down because that's going to determine if the Bank of Canada is going to continue to increase interest rates. The Federal Reserve has increased rates by 0.75% this past week. It was their third rate increase in a row. And they've signaled for more increases. And they are estimating that we may reach 4.4%. Currently, it's 3 to 3.25%. They're estimating it may reach 4.4 by year end, and that is 1% higher than what they estimated in June. So they are revising their prediction upward. And the curious part is in the question and answer period, they even, the chairman of the Federal Reserve, Jerome Powell, was asked about, are we to expect real interest rates, real positive interest rates? That means an interest rate that is higher than the rate of inflation. And he was saying, yes, over time, he would expect to see real positive rates. Now, I don't think that's realistic. He's probably saying that just to help guide the market, especially towards another point we're going to bring up later. So here's one of his quotes. We have just moved into the very, very lowest level of what might be restrictive territory. In my view, there's a ways to go. So again, he's guiding that rates are going to go up further. Restrictive territory means that rates have now come into a point where it is materially starting to slow down the economy. Now, we're already seeing it in some areas, not in others, but a restrictive interest rate means that the interest rate is going to slow down the economy. And what he's saying is we have entered it. And one of the things that is the silver lining in all of this is despite elevated inflation, long-term inflation expectations appear to remain well anchored. What inflation expectations mean is what are the general consensus? What is the population's belief of where inflation is going to be a year from now, 2 years from now? And most of society expects inflation to not be as high a year or two from now. That is very important because if everyone expects inflation to be high, we then make inflation high. It's one of those things where when everyone expects higher inflation, they demand higher wages. They prefer to sometimes spend more upfront, and that increases the cycle of inflation that can really spiral out of control, as we saw in the 70s and 80s. We also have some uncertainties when it comes to interest rates and just the economy in general. The supply chain disruption in China, they still have a zero COVID policy, meaning they will lock down a city in order to reduce the number of COVID cases. And that is significantly affecting their exports as well as their economy. And their exports are affecting the rest of the world where we can't get parts due to shortages, etc. So that is causing inflation in one way, because if you can't have enough supply, then the price goes up, which causes inflation. The Ukraine war is affecting obviously energy prices. There's also some agricultural, like grain, that's the price of grain that's really being affected by it. So there's no clear answer what we're going to see as an outcome to that war and how it translates into the effect on interest rates. And we're seeing monetary tightening, which is the Federal Reserve increasing interest rates and also reducing their balance sheet. Now, I don't want to get too complicated, but basically the Federal Reserve owns a lot of treasuries, US treasuries. These are government bonds. And by owning it, they've been able to reduce interest rates to a certain degree. They've been continually buying it. They've been a net buyer for the past while, since the 2008 financial crisis. They are now attempting to reverse course and sell their treasuries. And one of the people I've been following is Jamie Dimon, who's the CEO of JP Morgan Chase. He's one of the few US bank CEOs that survived the 2008 crisis, meaning he's still the CEO. He was the CEO before 2008 and he is now. Mostly everyone else got fired or they left their job and they've been replaced. But he's one of the few that remained because he guided his bank through the 2008 crisis by removing risks from the bank and deleveraging well before he needed to, so that during 2008 and 2009, he led the bank in acquiring other banks that were going bankrupt because he had the ability to and the financial resources to. So he's someone that, from listening to him, I deeply respect his insight. And one of the things he's saying right now is there is a hurricane coming. We are going to see something in the financial markets that we have no way how to predict. And a big part of that is the monetary tightening as well as the Ukraine war. Like, those things don't have a precedent for us to know what's going to happen, how it's going to turn out. So definitely that presents a lot of uncertainties. All right. Now, before we get into mortgage penalties, when it comes to deciding on whether you should lock in your mortgage interest rate, a few things you should consider are, if this is a primary residence, are you confident you're going to be able to continue living in the home for the next 5 years? If it's an investment property, the answer becomes less clear, because while everyone hopes to own their investments for the long term, things arise where people end up selling it. So even on the investment side, you have to understand, do you have the financial resources to hold on to the property long term, or is the equity you have in the real estate you own, the rental property you own, part of your emergency savings? So if you were to lose your job, if something else were to happen, do you rely on that, whether it's through borrowing against it or whether having the ability to sell it? This is very important, because when it comes to locking in your mortgage rate, you need to know if you can keep the mortgage for the duration of time. Based on all the information I shared, there's no clear answer if you should or should not lock in your mortgage rate. Right now it's at 5%-ish to get a 5-year fixed, 5.25 maybe. That is not a low interest rate, but it could go higher. So it's almost guaranteed to go higher in the short term. The question is, does these interest rate hikes do the work they're supposed to do? Does inflation continue to slow down, as we've seen in the last few months here in Canada? And if it continues slowing down, or if the economy slows down sufficiently, does the Bank of Canada then decide to reverse course and slow down the interest rate hikes? And the key part with that is the Bank of Canada is watching the United States Federal Reserve, because our economies are very intertwined. And currently, the head of the Federal Reserve, Jerome Powell, is extremely insistent that he will not stop until inflation is under control. And honestly, I respect him for it. It is not an easy decision to make, because he's described it. The pain we feel upfront is less than the pain we will feel if inflation spirals out of control. And I believe it. It's just, it's something that most people are not willing to do, except short-term pain for long-term gain, which is why I respect his ability to basically fight for this, fight to increase interest rates and reduce inflation. So anyways, all that to say, the question is what is the next year, 2 years going to bring? In the short term, interest rates are almost destined to go higher unless the economy slows down sufficiently. And then when the economy slows down sufficiently, there is a correlation to that and inflation. So inflation may slow down because the economy is slowing down. So those things can go together, which may hopefully help the Bank of Canada to not have to raise rates and maybe reverse course. We don't know. I think the best thing you can do is to put yourself in a financial position where you have the resources set aside to get through these next 1-2 years at a minimum. So let's go to one of the important considerations to think about if you are considering locking in your mortgage into a fixed mortgage. If you have a variable rate mortgage and you want to break it, you pay 3 months interest. That is the typical penalty. If you have a fixed mortgage that is fixed at an interest rate lower than the current rate, so if right now the interest rate is 5% and you have a mortgage fixed at 4%, typically you can break it for a 3 months interest penalty. The challenge becomes if you lock in a mortgage that is higher than the current rate. So for example, if you lock in today at 5% and interest rates go down in the next year to 3%, and for whatever reason you need to break that mortgage, you're trying to sell the property, you're trying to refinance the property, if you need to break that mortgage, you will then need to pay what's called an interest rate differential. And an interest rate differential is calculated by the difference between the rate you have locked in and the current rate multiplied by the mortgage balance, so the size of your mortgage, multiplied by the term you have remaining. So if you started with 5 years, you're 1 year in, then you have to multiply that difference by 4 years. This can be a significant penalty. So let me give you an example here. If you have a $500,000 mortgage at 5% fixed, rates go down to 3%. So that's a 2% differential. And say this happens instantaneously, you still have 5 years left on your term. Your penalty to then break that mortgage because you need to sell the property due to a job loss or something is going to be $50,000, close to 10% of the value of your mortgage. So that is nothing to laugh at, but this is only the circumstance rates come down significantly after you lock it in. If you lock it in and rates go up and you want to break it, no problem, 3 months interest. So again, this is something to consider. My preference right now, and to give you context, I currently have $2.5 million in outstanding mortgages on my primary residence and on 4 rental properties. So I am watching this closely. This matters materially because my family's financial situation is on the line, as is of those of our clients, right? I am not locking in my mortgages right now. I don't know if rates are going to come down in the short term. And honestly, I don't even know if they're going to come down in the medium term. But it does appear that the guidance of the central banks is that rates will come down. So maybe they do come down if inflation subsides, or maybe they don't and inflation continues to go. I don't know. I am currently, most of my mortgages are fixed payment variable rate mortgages. So what ends up happening with these mortgages is that even though rates go up, the payments stay the same. So the interest rate is going up, but the monthly payment is the same. And this is allowing me on 4 of my mortgages to have the payments stay the same. Some of them are approaching the point where the payment is interest only. I am perfectly happy paying interest only payments because it keeps my carrying costs low. It keeps my cash flowing properties cash flowing. It keeps my home mortgage payment at a satisfactory amount. There will be a price to pay later. You're going to pay extra interest as a result. But my goal right now is to maneuver my finances and the portfolio I have over the next 12 to 24 months. That is my priority. So if I end up after 2 years, 3 years with a little bit more of mortgage debt, that doesn't really bother me. What does bother me is if I am in a position where I have to take significant losses. So that is what I am trying to navigate this through. There are some other solutions to this without taking a fixed mortgage. So if you do have assets outside of real estate, you always have the option to pay down your mortgage. That is like getting a 30-year fixed mortgage, because if you pay off the debt, the rate can never go up on you. You are insulated from rate hikes. And a final option for those of you who have investments outside of real estate, but maybe in a non-registered stock account, you could do what's called the Smith maneuver, which is to sell your stocks, for example, withdraw the cash, pay off the mortgage, borrow a new mortgage, and buy those same stocks again. The reason you would do something like this, especially for a primary residence, is you would make the interest on the mortgage tax deductible because you're borrowing to invest. If you were to do this, it essentially reduces the amount of interest you pay by your tax rate. So when rates were really low, there wasn't that much value to doing this. But now when rates are high, if you are in a higher tax bracket, it could cut the interest you pay by almost half. So even if you have a 5% mortgage, you could cut it to 2.5% after the tax benefit of a Smith maneuver. So something to consider. When it comes to real estate investing, our framework is the same. We want to buy good homes in good neighborhoods. We want to buy it with a margin of safety. And for the most part, that has been positive cash flow. That has shrunk a lot since our purchases in the last year. However, another way to have a margin of safety is to have cash on the side, to have other investments on the side, to have access to liquidity so that if you need to, in the case of turmoil in a short period of time, you have funds available if rates do increase more. And the third part, which is very hard to do, is to do nothing. So I'm not selling my properties right now. I am holding on to the real estate that I own as prices are coming down, as more uncertainties unfold in Ukraine and supply chains and interest rates and all of that. So I am not trying to time the market. I'm not trying to make any decisions related to that. So again, when it comes to choosing to fix your mortgage rate or not, personally, I am not fixing my own mortgages right now. If you're in a place where you live in a primary residence, you want to fix your mortgage, you're going to live there for the next 5 years. You can manage the payments right now at 5%, but you won't be able to manage it any higher. There is a case for fixing it. I don't like it, but if that is the route you choose, I wouldn't tell you that you're making the wrong decision by any means. This is a very personal decision, but I think the most important thing is to have a margin of safety right now, to have funds set aside that you have access to. And currently that is what's giving me the confidence to keep these variable rate mortgages with fixed payments. If you are interested in learning more about what we do and investing in real estate, we have a Welland investment tour coming up in October. Link is in the comments below. And you can come see some of the triplex conversion projects our clients are purchasing even right now that have the potential to create positive monthly cash flow. We take you through the properties, we give you all the numbers, what's involved, we answer your questions. So it's a free resource. If you're interested, check it out. Until next time, all the best.